Hello, everyone. Great to have you with us today. We will give one more minute for people that are still coming in, as I see a lot of people are still joining, and we are about to start. Happy April 1st to everyone. The best joke I've seen so far today is that Apple is purchasing TikTok for $500 million, or sorry, $500 billion. So feel free to share your best April 1st jokes in the chat, especially if they're related to embedded lending. Whoever joined just now, we are waiting for 10 more seconds before we start, giving a last chance for everyone to join. Thank you, everyone, for taking your time out of your day and joining us today. All right. So here we go. Welcome, everyone, to today's webinar, Buy versus Build for Embedded Lending, Unfiltered, Unbiased, Uncut. Quite the mouthful and quite the promise, but I am confident our panel will deliver. So three experts, one CEO, and a moderator walk into a webinar. This may sound like a joke, and that's exactly what's going to happen here today. I'm Yuda Matar, your moderator today, and that's not the last corny joke you'll be hearing from me, but I do promise I'll do my best to keep the panel on track and hopefully slightly entertained. Before we dive in, just a bit of housekeeping. After a quick round of introductions, we will dive into the panel discussion, and we will leave 10 minutes for your questions. You can leave your questions in the Q&A section below in the control panel of Zoom, if this is the first time you're in a Zoom webinar. And you can do that already now, so you don't have to wait for the end to write the questions. We will simply address them in the end. If we don't manage to address all the questions, we will make sure to follow up with answers with the help of our panel of experts. In addition, stay tuned for two little surprises during the discussion that I think will give you additional insight into our topic. So today, on April 1st, luckily no fools on our panel, we will be diving into embedded lending and tackling one of the industry's biggest existential questions. When planning digital and embedded lending programs, should you buy or should you build? Our webinar's title refers to embedded lending, but I'm sure a lot of the stories and thoughts we are going to hear are relevant to the more general questions banks and companies face in general when deciding to launch these types of programs or any digital and embedded programs. And many of the points we'll discuss are relevant beyond lending. By now, you may have realized that I enjoy talking a little bit too much. Luckily for you, I'm mainly here to listen. And I'm joined today by an incredible panel of industry experts, people who have actually lived the buy and build dilemma multiple times from all sides of the fence. I'll let them each briefly introduce themselves, and then we will jump straight into the conversation. Eva, can you lead us off?
Sure, happy to start. Eva Wójcik, part of Accenture. I'm leading embedded finance in the UK for Accenture. Spent last 15 years working mostly with banks, so mostly FS sector, but also with the companies looking for financial services solutions, so with telcos, e-commerce platforms, as well as retailers. So very happy to be here. So thanks a lot for the invite, and looking forward to the conversation.
Thank you, Eva. Great to have you with us. Gaurav, on to you.
Yeah, thank you. Gaurav Sethi. I'm the founder, CEO, and principal of Innovation and Consulting. It's my practice that I started to help banks and fintechs with their growth strategy, particularly around embedded lending, but also some other areas. Prior to this, I spent over 2 decades as an operator in different banks, most recently as the chief product officer, but also had other responsibilities and roles at banks like Citizens, JP Morgan Chase, and Capital One.
Perfect. Thank you, Gaurav. Pleasure to have you with us. Dave, on to you.
Thank you, and thanks for the opportunity. So Dave Wilno, partner in the UK firm at EY. I look after banking, capital markets, and payments in the UK environment, but also do work across the EMEA region. I bring 25 years worth of banking experience, working with organizations through this tough decision around how do you integrate with third parties? Do you build? Do you buy? What components do you want to own? What components do you want to leverage from a partner perspective? And these are covered some of the topics we'll talk today around time to market, cost, and the rest. So looking forward to the conversation. And I think there's going to be lots of varying views, and hopefully we'll have a great discussion and lots of questions as well. Thank you.
Amen. Thank you, Dave. And last but not least, our very own Yaakov.
Great to be here, and thank you all for joining us. My name is Yaakov Martin. I've been Jivity CEO for quite a few years. We too work with banks, financial institutions on the one side, and corporates, merchants, service providers on the others to launch, I would like to say, creative embedded finance and embedded lending solutions throughout quite a few markets, verticals, and industries. So great to be here.
Thank you, Yaakov, and I'm excited to judge by our panel's experience and also by their adherence to the time limits I gave them. I think we're up for a good conversation. So past the shared intelligence of the panel, I think it's also important to note the experience that this panel has with this topic in the industry. More than 30 years of banking, 18 years of consulting, 16 years of helping banks with different software solutions combined. So I think we hope to learn from all that in the coming hour. So let's start with embedded lending. Embedded lending is like basically assembling my 3-year-old's new bike, right? The instructions look simple enough, but suddenly I'm holding 3 leftover screws, the pedals are backwards. So let's start with clarifying terminology. When we talk about embedded lending, and I'll let Yaakov and Gaurav start here. What is embedded lending and what are its components?
Gaurav, how about you go first?
Yeah, I can start. So simply stating the definition, right? I would say it's offering credit solutions or financing solutions where customers already are in a contextual manner. So as opposed to offering credit sort of separately, which in instances where you're maybe getting a mortgage or an auto loan, you're applying for it at a bank and then going to whoever the merchant or the auto dealer might be. Those are separate sort of instances of getting credit to enable a purchase, versus embedded lending is the contextual nature of offering credit in the journey. So I would say it's sort of the very high level 50,000 foot view definition. What's involved in that obviously is a lot deeper because it's the contextual nature allows for gathering real-time data and offering personalized financing solutions based on what you know about that particular customer and that particular instance at that particular merchant, et cetera, et cetera. So we can get into that, but that's, I would say, the sort of overarching definition to me.
Yeah, I completely align with Gaurav. I used to like to describe embedded lending to my mom, who is not very experienced in embedded lending, as offering bank-grade products outside the 4 walls of the bank. And that is obviously on a very, very high level, super high level. And Gaurav, you gave that a lot more color. And I also like to say that in terms of the mission with embedded lending, we actually look to bring the bank to the customer rather than force the customer to come to the bank. And that, of course, plays out in this type of embedding exercise and creating a seamless journey. However, I would maybe tweak that definition because we are finding more and more the need for embedded lending even, or embedded finance, even within the ecosystems of many of our banking and financial institution partners. We have found that throughout many of their digitization journeys, and understanding the nature of the businesses of many of their customers or other needs of consumers, they actually sometimes need to practice embedding their offers even when their customers are still within the ecosystem of the bank itself, And we are currently involved in some very interesting programs and projects that really do both. They offer embedded finance outside of the bank, but they firstly, even I would make sure, I would say make sure that the experience is seamless within the ecosystem of the bank itself.
So when we look at the pair of words, embedded and lending, the lending aspect is something banks have been doing for generations. And the embedded aspect is taking that lending activity, putting it inside a contextualized environment. And what Yaakov, I think, is saying is that a step before embedded is the ability to offer that lending activity fully digitally, right? So we have digital lending, we have embedded lending, and to Gairav's point of not needing to step into a bank's office and start asking for that loan, rather doing it from the comfort of our own home or in the context of whatever we want or need that loan to be. Any other context or additional thoughts around embedded lending from our panel? Specifically, if Gaurav and Yaakov and anyone else, if we can pull the curtain a little bit back and talk about the building blocks that enable and necessitate digital and embedded lending.
Yeah, maybe I can start on the building blocks, and then feel free to chime in, guys. But some of the key components, right, that as a bank I would look for. First, you start with a clear strategy, right, of exactly what you want this particular product or line of business to mean for you as the bank. Because there are many different lending strategies and there are many different embedded lending strategies, and you might have seen all kinds of flavors between what some of the fintechs like Affirm and Klarna are doing versus some of the banks like Citizens or Citi and so on are doing. But once you're kind of clear on that, right, it starts to shape the different building blocks. Obviously, the crux of it is because it's embedded, it's contextualized. Which means one of the key components is your customer and your merchant experience, right? So how are you being contextual and how seamlessly are you integrating your lending into the ecosystem, right? Into the merchant's ecosystem and into the customer journey. So that's kind of a core component. Part of that component is the technology itself, right? And the API infrastructure that you have to handle this lending, which also includes kind of real-time decisioning. So the decisioning is your risk and credit strategy, your models, but not just the inputs of the models, but also the real-time nature of handling the decisions real-time instantaneously, right? And can you do that on your own? Do you need a fintech partner? Do you need to buy a solution, et cetera? Then you have to look at sort of your distribution channel, right? Which is, are you trying to be a one-to-one lending solution to individual enterprise merchants, for example, or are you trying to build a scalable distribution channel where you're offering your lending product across thousands of merchants through some platform, right? Because there are differences in how you enable that, but also the economic model is different. And then the last sort of big piece I would say is the regulatory and compliance part of it. It's a very key building block, which is this any different from any other regulatory and compliance needs that you might have with other lending products, for example, like a credit card or a auto loan. And there are nuances here, right? Because you are providing lending solutions most likely outside of your own ecosystem. And so there are stronger sort of controls that you need to ensure, right, that what you're doing is also what maybe your platform partner or your merchant partner is doing to be compliant. Anything else to add there, Yaakov, or anyone else?
I think you really hit it on the head. Again, if I were to try to frame this conceptually, we're speaking about programs that are bridging very different environments. And every single one of those bank products that are now offered through other, what I like to call foreign environments, compound the complexity of the offer. And of course, as Gaurav said, when you piece it together, when everything is aligned to offer the right product through the right journey on the right platform to the right customer, then it's a big win. But if any one of those things go wrong, you may find that all of the effort and the investment is not really paying off. And therefore, I think that in essence, what we have to remember is that embedded finance, and specifically here for the topic that we are discussing, embedded lending, is complex. It has many, many different, as Gaurav explained, components to be considered and to be pieced together in a scalable manner. And I think that's what we're going to try to cover during our session today.
Excellent. Thank you. So very quickly to summarize so far, embedded lending is a massive opportunity for banks to access new channels, new populations, and lenders in general, of course. But on the other hand, presents new risks and new challenges that we need to overcome. So now we, in general, understand that our bike is assembled, or at least we know what parts there are. Let's attack the question that we're all here to solve, which is how to find the balance between trying to put the bike together ourselves or calling the helpline for some expert help. So to build or not to build is our question. And I think that a good analogy to understand the spectrum we are facing is buying a cake for my 3-year-old's birthday. I can simply buy the cake completely, or I can make the basics myself and I can buy the more expensive complex ingredients, or I can basically bake everything from scratch, right? So buying obviously would be buying the cake, building is making everything from scratch. And I think that's the spectrum that banks will face and when they come to this discussion, right? And given that there is this inherent complexity of embedded lending that Yaakov described, and that there's the upfront cost and effort needed, what should banks consider at a very general level? And how have you seen banks successfully assess their position on this dilemma?
Happy to start here. So for me, there are quite a few different considerations for the banks, and there are some that are coming straight to everyone's mind, which is time and cost, that's always on the top of everyone's head. But I would start actually with the strategy. So partially what Gaurav was mentioning earlier. So to looking at what you want to achieve. So do you want to have a complex product, or do you want to have a product which is really straightforward, at this directed at the specific audience and specific customers? How do you want to distribute? So again, are you aiming to have a product that will be distributed to multiple mid-sized merchants, or are you planning to develop something a little bit more bespoke for 3 or 4 different companies? Because that is a very different conversation, and that's a very different conversation around how much you, for example, can take out of the box versus how much do you need to build and customize. And on the back of that, what I would do is almost get the value chain that I think Gaurav mentioned a little bit in a way as well, and go through the end-to-end capabilities that you have as a bank, from sales, product, onboarding to actual processing, servicing, back office, and see which of those boxes in a way you have, and which ones you want to keep in-house versus which ones do you want to buy or partner for, or which ones you think you have, but actually they are not to the standard that you want to keep proposing to your customers. And then on the back of that, almost prioritize what your ideal state is, and then go to the market. So it's quite a lot to do before you get to the point that, oh, you know what, I want to build or I want to buy, and it's usually not black and white.
Maybe I can add a few things in there. So I fully agree. I think the key thing from a strategy perspective is starting with what is the differentiation that you're going to get by build versus buy. So if this is something that you see as a competitive advantage, where you see your organization, your culture, your strategy and thinking that you want to differentiate and be completely unique in market, then you may want to err more on the side of a build strategy. If you're looking for something that is more commoditized in nature and something you want to add onto a bouquet of services, you might then look at a buy strategy. In my experience, and we'll talk a bit about this later, I think, as we talk through some of the experiences and lessons learned, is that even if you go with a buy strategy, there'll always be some level of configuration and customization that you would want to do to your platform to personalize it to yourself. So I think that is always going to be part of the journey. I think the key things that come through this is, as was explained earlier, is what's driving the agenda. Is it time to market? Is it simplification? These things will obviously then allow you to take on more of a partner ecosystem in that journey so that you can get to market quicker. If this is something that you want to test the market and test appetite and see if there is a market to be had in that space, you may then potentially use more of the partner ecosystem. And as you learn through that exercise what really works for you as an organization, or whether this is a longer term strategy, then you can start to say, how do I start to integrate this more deeply into my ecosystem? So I think that would be certainly part of those conversations. The typical things we see around that are owned internally by certainly the tier 1 and larger banks are things like onboarding. And why is onboarding important? Because there's an obligation to you as the financial institution around how you onboard, the FICA, the AML components that you would need to look at. And to outsource that is sometimes a stretch too far for banks to look at. The second thing is your credit decisioning. Often that is wanted to be owned by the organization. So what you typically see is that starting in an environment there where you want to get a market very quickly, you want to test and learn, see if this is a market you really want to invest in. You do a lot more of the outsourcing and partnering through a buy process. And then what you do is, as you learn and you create some of those capabilities and see that this works for your organization, you may start to pull some of these capabilities back inside because you want to own and control those journeys. I think an important point that Eva spoke about was sometimes we forget about the servicing model as well, and that's often where it gets very, very complex, is around a customer who is engaging with a bank who now wants to service their embedded financing capabilities as well as the other products on the same platform. How do you manage that effectively? And this is where sometimes the real complexity comes in. It's less about the acquisition part, but more about the servicing piece, which means you have to do some complex integration so that the customer has a unique experience, a conformed experience across servicing all of their products with the bank, not just the embedded financing opportunity they have. Last thing for me on this one is, in my experience, when we start these journeys with our customers and we go through this journey of discovery around build versus buy, we often see that we oversimplify what is actually in the capability. So what you find is the third party that you may buy a product from has been doing this for 10, 15, 20, 30 years. They've learned a lot around what the market expects, what is good in the market, what's bad in the market, and sometimes we oversimplify the experience that the third party has in that ecosystem and really making sure that the product works. And that will include things like integration into digital platforms, integration into point of sale. These are all things that are, although at a principle level seem quite simple, when you get into the nuts and bolts of it, they're actually quite difficult things to integrate into. And that span of integration to third parties becomes very difficult. So I would say that's the other key thing, is actually the experience and the skills that a partner can bring to the party, certainly in that initial phases as you're testing and learning and growing into the environment, is often very important that even if you don't buy the technology from them, is you try and partner with them around understanding the experience that they've learned to market over often many decades of doing this for many customers. Something to think about.
And maybe I'll just add two thoughts to the last portion of your words, Dave. We've heard here quite a bit about the building blocks and the complexity, and I think if I listen to all of you and compare it also with our experience, once again, if you take a step back, there are actually three different elements that these considerations of buy, build, and we'll speak about partner and what that means, at least to me, maybe later on in this session. But when you really do look at the various components, you can put them into three buckets in my mind. There is the actual financial product that the bank, and as Dave said, often wants to keep in-house, the decisioning that underlies those products, the type of products. Are these revolving lines of credit? Are these split pays? Are these installment loans, et cetera, building or making sure that you have the right type of products in order to serve up and match the need of the customer at that endpoint, wherever it's embedded. That's bucket number one. Bucket number two is the solution the platform, the way that you're going to embed this, build the journey out, do the onboarding, and every other type of component that needs to fall into that flow in order to capture the information you need and render a credit decision. So I consider that to be bucket number 2 in terms of the technology, the platform. And then finally, there's a third bucket that is not solution or technology oriented at all. And this was mentioned before as well. And that is the market itself, building the business. Are you focused on business that you already have? Do you have a very developed merchant servicing business where you can then add this capability into the stack of services that you offer? Or are you going to have to go out and make the market and invest in bringing on new opportunities and new merchants and so on and so forth? And the dilemma of build, buy, and partner, as we'll speak about a little bit later, I think applies separately to every single one of these buckets. So while you may decide that bucket number 1 is core to the bank, bucket number 2, as Dave said, is benefiting from a platform that operates in many different markets, many different verticals, many different types of integrations. I think one of the things that we found that often, once again, our partners tend to simplify before they actually meet reality is the fact that not only do you have to go through those type of deep integrations into foreign retail environments or other types of environments, but you also have to maintain them over time. And as we know, those environments are constantly changing, and depending on the complexity and the number of touch points that you want to show up for the end customer, there is more work to be done. And if you're investing all of that work only for yours, as opposed to a platform, for example, that is doing this for 20, 30, 50 different partners, there may be efficiencies to be taken into account. And then finally, like I said, building or partnering or buying a distribution in order to make the market is another separate consideration that has to be taken. The way we see it is that each one of these elements has to be considered separate.
Okay, off to quite a start. Ava pointed out that obviously before the build or buy question, there is a crucial question that comes before, which is what is the strategy? What do we want to achieve? Why do we even want this? And of course, mapping out what do we already have, what do we need. Dave went on and explained that the components that we need to own as a bank are often something that need to be considered, as well as what is the competitive advantage? What is the benefit that we are bringing into the market as a bank, as a lender, that will differentiate us? And of course, panelists, feel free to keep me honest as I'm summarizing your complex answers to one-word sentences. One sentence. Fascinating. Yaakov, I'm going to push back on you and say, let's talk about build, buy, and partner now. So what is exactly the dilemma there? What are the differences between building and partnering? And let's try to take this from the theoretical to the practical. Panel, you do not have to name names of clients and banks, but please share with us some examples of, and put this in context of successful implementations or failures, and how the discussion was around that dilemma for the banks you've worked with.
I'm happy to take this, although if anybody else wants to comment on their experience beforehand, I'm happy to go later on as well.
Go for it. Yep, we'll follow.
Okay. And I'm not sure that we'll all agree on this, but I'm once again going to sin and speak about this conceptually. I personally do not see partnering as a compromise between a buy and build. I don't look at it as the middle of the spectrum that Yuda described beforehand. I see it as a third option altogether, or maybe it depends on the type of partnerships, but these are definitely the type of partnerships that we try to lead and that we try to achieve. A partnership, as far as I'm concerned, is breaking down both organizations, meaning, let's say, the bank or the lender, the financial institution on the one hand, and a third-party solution provider or partner like ourselves, breaking down the capabilities to their core components and figuring out how those core components can come together through an exercise of configuration and sometimes customization to deliver on the strategy that the bank or financial institution has carefully articulated. And it's a bit of a chicken and an egg, because we do not live in a theoretical world where strategy can be built without understanding the level of effort, the time to market, the level of investment. And therefore, there is a need to actually put all of those pieces on the table together, and based on that, start to come up with a strategy where both parties' expertise can really shine through. And once again, I'm going to refer to many of those foreign environment needs, integrations, journeys, complexities. Those are areas where, at least from our experience, if we are able to bring that to the table and have them amplify and deliver the products that the bank feels that they have a unique offering in, that is the type of partnership that we've seen successful. When one party attempts to almost, I would say, overstep into the other party's territory, we often find quite a bit of wasted time, effort, and investment. There has to be a very, very clear understanding where the core expertise lies, where the scalability and flexibility lie, and bringing those two together create the right type of solution, at least as far as I've seen before. And therefore, I like seeing it as a third option altogether, as opposed to a compromise in the middle of the spectrum.
Happy to jump in. So maybe so I don't disagree. I think I'll come back with some of my thoughts on that strategy specifically, but maybe a couple of examples of what I've seen as the good and the bad. I think often as an organization goes through the decision-making process, what I have seen is I've seen a starting point around the strategy being very clear on what they're looking for from a partner and a partner execution, but then over time that strategy shifts and it moves. And often what you do is you start with a very clear understanding of roles and responsibilities. Partner does this, in-house we do that. And then as you work through the complexities of organization, those things slowly, the barriers start to blur and it becomes difficult. So I think that point is often the case. And that's often as a result of not necessarily the product team coming up with the vision, but it's internal workings of an organization. You've got things like, we spoke about onboarding, we spoke about credit, we spoke about the kind of economic crime prevention, fraud. All these things they sort of slowly break away from sometimes the value proposition that you started the intention with the partner on, and you start to break these things down. And then that becomes a bit blurred in that structure. So I've seen that a lot, where, starts off with a very clear direction and strategy, but over time these things shift. So I think that's one example. I think the other thing that I think having is those of you who may have looked at my LinkedIn profile, I've worked both on an SI and I've run my own company as well as a bit of a fintech, and I've also worked in a bank and now working in consulting. And what I've seen is that the third party often brings a lot of energy and a lot of kind of structure to a thinking process, but then trying to integrate it into a very complex banking environment is a very lengthy process. So part of the journey as well is actually understanding the effort it takes for a third party to integrate into this complex world is not something that happens in a fintech mindset, which is in weeks. It often takes months and sometimes years. And it's that patience to work together as partners, understand this is a long-term journey. And once you've done that integration, you're not there just for a 6-month period, but you're there for a lifetime. And often that is a barrier to that partnership relationship, because the expectations of the third party and the bank are fundamentally different at the start. It's a lengthy journey, and these things become a conflict in culture as well that needs to work through. So I've seen this in a tier 1 bank where there was a strategic partnership that started. There was a massive amount of excitement around the opportunity. Fast forward 18 months, the product still hadn't gone live. And then very soon thereafter, the product that actually launched was a 10th of the capability that was set as a strategy. And not without the best intent in the world, but just the nature of these two cultural environments being fundamentally different, you saw that clash. And I'm sure, Jakob, you've probably had many experiences like that yourself. But these are some of the challenges to truly understand, if I'm going to buy a solution and I'm going to partner with a third party, what do I have to change as an organization to be able to accept this organization? And to your point, is be clear on the boundaries. So even though I can do these things, for the best success of the partnership, I shouldn't be doing them, and I know my boundaries. And with that, often what happens, and having come from a banking environment myself, is that the leadership changes as well. So your strategic sponsor inside of an organization also shifts and changes. And that's also a challenge around keeping the momentum around that strategy over time, as well as a consideration. Another key thing which I've seen many times as well is that it's the risk of the third party. So often a third party is owned by a PE house or has investors, and they're looking to obviously do some kind of growth and expansion and listing and the rest. And often a bank looks at this and says, there's a potential threat if I go all in with this partnership, that at some point in time, their future will change, and then my future is uncertain. So how much do I invest in this? How much do I not? So there's lots of complex things. And the reason why I'm raising these things is these are all examples I've seen where it's started off as I always talk about, use the analogy of you date and then you get married, and then sometimes you got to prepare for the divorce because it might come down the line. But these are things you start, you date, everything's exciting, you get married, you realize it's not quite as easy as you thought it was going to be. And at some point in time, you may have to realize that you have to part ways in your journey. And I think that's, if you walk in with that sort of mindset and you plan for those events, I think you'll have a much better journey moving forward. Spoken a bit about the negatives. I have seen the converse also being very true. Currently working with a couple of clients at the moment who internally have been trying to deliver internal capabilities and take them to market, and they've been on that journey for many, many years. Been unable to get common understanding and clarity, being able to prioritize the work that needs to be done internal to build the capabilities, and now realizing that they're falling behind their competitors and their peer groups. So they actually don't have a choice. They have to go and out and buy certain components because that's what they need to do to remain competitive in market. So it's not by choice, it's actually by necessity. And we're seeing some of those successes coming through, and they're hugely successful. So much so that I think it's changing the philosophy around how do we partner more going forward around specialist firms as opposed to trying to build everything ourselves. The banks themselves typically have a mountain of work to do and not enough resources to do it. So to partner strategically with certain embedded finance capabilities or others, there seems to be a shifting strategy towards looking for the right opportunities. I'll stop there, otherwise I'll use up all the time. There we go.
Excellent. Thank you.
Maybe I can add just
yes,
one other thing, because I think we're talking, and I agree with all of those points, spot on, right? I was also thinking about the buy, build, partner kind of question, not just in terms of the product or the technology, but as a relationship, because by the nature of kind of what this product is, it's embedded in some other entity, whether it's a merchant or a platform, in kind of their ecosystem, right? And so as a bank, you also might be able to build or buy the best technology in the world, but you may not have the relationship that a client X, Y, or Z may have with a platform, right? And they might not want to change their relationship with that platform, and so they might kind of dictate that as well, right? And so relationships, and from a kind of business development or sales or commercialization standpoint, is also an important consideration to think beyond sort of product and the technology itself.
Thank you, everyone. Excellent points all around. And I think that the analogy of a relationship is, I think, very relevant. I took my wife to Africa for a honeymoon, and psychologists say that traveling together as a couple is the best test for the strength of a relationship. So maybe banks and partners just go on a month-long trip in the mountains and see if they come back alive. But I think that Dave and Gaurav's points to this relationship piece connects heavily to competing expectations, right? So we have two players, the bank and any of the partners you're looking to play with. And I think that leads us to the next topic nicely, which is the perception and then the reality, right? Everyone has a plan until they get slapped in the face. But before we actually jump into that very interesting topic, a few quick points. I see that questions are coming in nicely. Please keep them coming. As I said in the beginning, we will dedicate 10 minutes or even more at the pace we're going. Everyone is answering to the point and nicely, so thank you for that. Keep those coming in. And in the control panel below, you will have a button called Resources. If your screen is small, then it's under the 3 buttons of More. And our marketing team has very helpful created a infographic detailing the embedded lending buy versus build dilemma. I found it very helpful, and I encourage everyone to go and download it. You can look at it while we continue the conversation, or just read it later. So that's about the infographic and about our questions coming in. Let's really jump into that point about perception versus reality. We understand there really isn't a correct answer to the buy and build and partner dilemma. Every bank needs to assess their unique position, their needs, and of course that answer, as Dave showed, can change 3 months, a year, 5 years down the road. And let's bring this theoretical discussion again to that reality. What is the biggest misconception banks have about buying or building that you've seen, and what's actually the reality?
I think so. I can start with this one, and I think Dave partially covered that as well in the previous question. But for me, it's on the integration side. So always at that very beginning, of course, when the banks are looking for the platforms, they are looking for, cloud-based, API-driven, event-driven, etc. So when the topic of integration is brought up at the point of those discussions, everything is very rosy and everything is great, everything is very quick. And it's almost not considered that you need 2 parties to integrate. So your complex internal systems obviously need to be integrated on the other side. And this is where, when you start getting into the details and start highlighting the exact points for the integrations and what you need, what are your requirements as a bank, what are your regulatory requirements, what do you need, maybe not real time, etc., then that gets much more complex, and that gets you spend much more time on that than estimated at the beginning. And I think the second very much connected with that are the ways of working. So again, it's a lot of excitement about the very quick, agile ways of working and putting products live in weeks and months' time. And then the actual governance kicks in, and then the processes within the banks, etc. So that slows it down a little bit as well. So I think that's another one that is very much underestimated in terms of time. And then the third one, which is slightly different, is on the use of the tools. So obviously, depending on what you decide, which model you decide to go for, you may decide that you want to change your decisioning engine. And as mentioned before, your credit risk policies and your credit risk appetite is usually what you want to keep within the bank. But then if you're getting the new tools, that requires upskilling of the people, that requires making sure that your internal processes, procedures, etc., are all aligned with that. And that's another one that is maybe thought through a little bit too late when you go for the project. I don't know if anyone has any other thoughts.
If so, then let's keep it to 1 or 2 minutes, Dave, because we have to
Sure.
move on. But yes, please, Dave, you were about to say.
Okay, I'll keep it very short. So I think the view in banks particularly is that they have all the skills and capabilities to build everything. So in theory, you can build the full capability from start to finish, and theoretically that can be achieved. I think the reality of this situation is that, as we've discussed, is that you have many competing priorities. So where does the stack up, embedded finance stack up against all the other priorities that the bank has? That is a key thing. The second thing is that I think often we look at the solution and think it's fairly simple and something we can build. We've spoken about the 15, 20, 30 years worth of experience that comes with the journey that we often miss in the situation. And then the third one, exactly to Eva's point, is that the complexity on integration and the fact that in order to get the value out of the third party, the full value out of the third party tool, whether you buy and the partnership, is you've also got to be prepared to change some of your internal processes to be able to adopt those capabilities fully. You can't just expect to operate exactly the same way you've been doing it for many, many years to be able to unlock the true value of the technology and the partnership if you go with a buy strategy. So those would be the key things for me that are fundamental to the success, and being truly honest around where you are capable and where you are good and where you need the partner support in your journey.
Perfect. Thank you. And I think that this returns to that relationship analogy of communication, right? A relationship is only as strong as the communication, everyone clear on their strengths, their capabilities, and their expectations of each other, both internally in the bank and with any external partners, of course. So now that we understood the dilemma, the components of embedded lending, I want to stop, and I'd love to hear from our audience. So you should see a poll pop up as I speak, and we'd love to hear your opinion about this topic. Please weigh in. We will publish the results right after you vote, and none of the attendees will see anyone else's vote. So we will give you some time now to put in your answers. Feel free to use your gut and just put in what is most attractive to you. And to incentivize you to answer, that I'll say that until I see some answers coming in, I'll use my prepared list of dad jokes. So don't worry about the poll, because your CEO won't know you chose the "I have no idea, I'm just here for the jokes" option. One thing is clear from this poll, though: deciding between build, buy, or partner is easy, said no bank executive ever. Watching this poll fill out, I can keep this going for all day. So hopefully you guys shut me up by filling this in. But we're almost at full participation. Unlike trying to put my toddlers to sleep, that's really a keep, sell, or put up for adoption dilemma. So slightly different. That was a little racy. I hope no one calls child services. I don't plan on selling my kids yet. So assuming I haven't driven away everyone with my cringy dad jokes, we have a nice percentage of participation already, and everyone's rushing to answer. So I'll put one more dad joke in there. Watching this poll fill out feels like my kids choosing ice cream flavors, agonizing slow at first, total chaos ensues, and eventually someone cries, which is me at the end of this webinar. No, completely kidding, of course. That's just my silly humor. We are at 45% participation, which is nice. Let's give it 5 more seconds to see if anyone decides to give some last moment opinions. Okay. So the poll has ended, and everyone should see in front of them now the results of this poll. And the first question is, what would most influence your build versus buy decision for a lending project? And it seems that the competitors for the lead are time to market and scalability and customizability, and that ties into the questions that we will see in a moment. What would be your biggest hesitation about building in-house? It seems that the most, not surprisingly to me, I think, but I'd love to hear our panel's responses, is development time and complexity, followed by lack of internal expertise. And if you chose to buy a lending solution, what would be the biggest concern? And it seems that here the leading answer is integration challenges. And the second one that I think connects deeply to what Dave mentioned is vendor dependency, right? If we are marrying, and I think that I've spoken to a bank recently who was burnt by leaning on a provider, that provider closing shop, and then being left with the inability to continue their operations. And I think the last one is that most of the webinar attendees are gathering insights, but a few are actively exploring this dilemma. So to those who are doing so, good luck. Dear panel, do we have any insights? Do these answers surprise you, or is this what you were expecting to see?
Personally, I think not surprised. I think maybe one or two of the questions we were leading the witness, if I'm honest. So I think we kind of prepped them for some of those answers. But I think it's fair. I think the honest answer is not a simple answer to these questions. There are so many considerations, and I think that's part of the journey, is going through and understanding what are the key important things. I'm looking at some of the questions coming through. I'm sure we'll answer that as well. There's some really tough questions there, and organization really needs to reflect on those before making a decision. This is not In my experience, these kinds of decisions are not short-term decisions. They are long-term decisions. Once you've done deep integration to embedded finance or any other solution, you're often there for a decade. So you want to make sure that you've thought through these things correctly, you've integrated them properly, and you've selected the right partners, because this is a long-term journey. It's not a short-term journey.
Yeah, I would maybe add to that, to Dave, what you were saying, in terms of looking at a framework where, at least the way I think about one-way doors versus two-way doors, right, where one-way doors are things that you are going to be, quote unquote, stuck because you made a decision that you cannot back out of. And that might be permanent, but it might be a long-term, like 5 or 10 years, as Dave was describing. And then there are some decisions that are two-way doors, right, where you can sort of try, test, and learn and figure out, what components you can sort of pivot. And once you've learned, you're then deciding to build on your own versus maybe switch vendors because the switching cost is easy. So those are like the key components, right, that you have to start to think about, right, is what are the pieces that are critical that need long-term decisions and treat those as one-way door decisions versus what are the, sort of more integrations that I can pivot, test and learn, adapt, and are not stuck with sort of either one vendor or one decision, right, if I decide to buy or build. So those are different in every case and in every bank, but just knowing internally what those are to you, I think is going to be extremely helpful to, not lock yourself in or overthink on decisions that may not be, or maybe more flexible than others.
Excellent. Thank you. And that was a really interesting poll. And looking at the time, we have 8 minutes left, and I wanted to make sure that, as promised, we will reach the Q&A stage. And a few minutes before the end, I will stop us and make sure every panelist has the option to finish with their last key thoughts as to what is the most important thing a bank should consider and take away from this discussion. We definitely got enough analogies that are helpful, right? The relationship, the one door, two door, these are all, I think, good frameworks for thought. So let's start with Kate McDonald, who is asking, many banks and financial institutions have multiple lines of business. Each line of business has specific purpose-built software that banks and financial institutions can buy to have purpose pre-built solutions. That said, you may end up with mixed UX experiences, multiple applications to maintain, complex business as usual environment. If we strictly build, it can be very expensive and take a long time, but allows for customization and consistent experience. The question is, what experience or examples can you discuss where a hybrid solution is created, where backend services are bought, but the UX is built?
So first of all, I have to say Kate is clearly listening attentively because she has just commented on her own question and suggested that some of these elements, at least, were maybe answered when we expanded on partnership. So thank you, Kate. I think maybe just to continue that a little bit, I think that decoupling is extremely important. We didn't really have time to go into this, but it kind of was weaved into many of the points that many of us, I think, made. And that is, once again, being able to understand that each one of these embedded journeys is really made up of a few different components. The more we're able to decouple and categorize and say, okay, the bank wants control, the bank wants a centralized servicing area, et cetera, that can be achieved. That doesn't mean that everything else outside of the bank's environment in terms of integrating and user journeys, et cetera, have to be built from scratch by the bank. And I think that as long as the decoupling can take place, thinking not only about the now, but thinking about where we're going, I think this can be achieved. A quick to market pace, a flexible and scalable embedded lending solution, and at the same time, those elements that need to be uniform and controlled within the bank's environment can be achieved as well. So decoupling would be kind of my keyword for that.
Awesome. Some of these questions I think can be answered rather succinctly, so let's try. The first question we had, can embedded lending also be referred to as pushing credits to the market rather than waiting for the client requests to come in. Would you, dear panel, define that also as embedded lending?
I'm not clear on the implication of pushing, if that's more sort of forcing a customer into sort of a lending solution, then I would say no, right? Embedded lending, to kind of my intro, really is all about contextualizing a solution as a customer is trying to make a purchase decision, right? And so if you're trying to buy that big screen TV, but don't want to put let's say $1,200 on your credit card or your debit card, having the option within sort of your purchase journey to say, okay, I'm going to finance this and I understand the terms. That's to me not pushing, right? That's contextualizing in the journey what options I have available. One thing I would say though on sort of pushing or marketing is a key lesson I've learned is just because you build a embedded financing or lending product or solution and have done a great job in sort of adding that into a checkout doesn't necessarily mean the customer is going to recognize and come, right? I think sort of creating the brand awareness and the marketing around this is a good alternative solution. You have to do a little bit of work as a bank and as a merchant partner to ensure that that option is well understood.
Perfect. Thank you. I think that in the importance of time, we will answer the rest of the questions offline. Anyone who's interested in the answers, please let us know via email. We'll make sure to include you as well. And let's now have the closing remarks from our panel. Your last challenge is, if our attendees remember just one thing about today's discussion, what should it be? Eva, let's start with you.
So for me is that what you go for depends on what your strategy is. So I think the importance of the strategy and the importance of the good understanding of your own capabilities and which ones do you want to improve / bring from the market.
Focus, focus, focus. It's all about that. Gaurav, off to you.
Yeah, I would say a couple of things. One, understand your strategy and what makes your solution differentiated. I think it starts with that because there are many, many options out there, right? And if you're another Me Too option, that's not going to really break through. But at the same time, when you're talking about buy, build, or partner, it's really critical to know what exactly your strategy is. Why do you want to do what you want to do? And then what are the best sort of options for that? The other is understanding the entirety of the ecosystem versus what you might be used to as a bank, right? So banks sometimes, especially when they're sort of new in this area, tend to use their same sort of credit policies and credit decisioning, their same operations and servicing platforms, their same pretty much sort of what they know to be true and has worked for them in their traditional lending, but that is not the case because here the ecosystem is broader, right? And there's at least one important consideration, right, which is your merchant partner, and so understanding their needs, their clients, their customers. And how you're going to operate and work with them is also critical. And so, whoever the either technology is that you're buying or partnering, how are they going to be the enabler to that relationship? And then the last thing I would say is truly understanding the compliance aspect of this. So I think we've touched a little bit on this, right? But there's not just the due diligence of making sure that you're either buying or partnering with the right folks, and there's a time and due diligence required to do that. But then there's also, in the marriage analogy, that's the dating and then getting married, but then the everyday washing your dishes and getting the food ready every day sort of stuff, having the right routines, having the right monitoring, having the right escalation paths, like all of those components are going to be super critical for your success. Because again, that's something that you are relying on someone else outside of your own tried and tested ecosystem.
Thank you so much, Gaurav. And over to you, Dave.
I'll keep it very short. So I think so my view is that buying can absolutely be a competitive advantage, but it doesn't preclude the hard work around doing the detailed design work, the detailed thinking, the detailed view of the contractual terms, the integration required, and all the things we spoke about. So what we often see is that because of time to market, we try and outsource everything to the third party and make it their problem. The reality is that you still got to do a lot of hard work to make this solution work inside your organization. So that would be my parting thought.
Thank you so much. Yakov, last 10 seconds.
Yeah, so quality of partnership, that's really, I think, what we have seen to be the most important ingredient in success. At the end of the day, these are long-term relationships. They're relationships like anything else. We spoke about that quite a bit here. You have to make sure that this is a party that you will ultimately be able to see as an extension of your team. You will be proud to work with and to win new business with. But if that quality of partnership is there, then everything else is a technicality that can be solved. And we saw this with serious partners and serious prospects who were willing to invest even in the exploration stage. And we have our own scars to show as well. So we'll speak about that at a different point. But really those places where we were able to foster and nurture a trusting relationship that was the underlying or cornerstone of the partnership, that's where we really achieved tremendous success together with our partners.
And with that note, I want to thank everyone for joining us. I want to thank our dear panel of experts on their uncut and unbiased opinions and experiences. I think that as an interesting follow-up conversation, we can talk about how AI is going to enter and change and mix all this up. But for now, thank you all. See you next time, and feel free to reach out if you want to continue discussing any specific points or ask any questions. We are here to serve. Thank you, everyone.
Thank you.
Thank you all. Bye-bye.